when the median age of India is still 28 and below, and we're talking about maybe at 22, when we'll discuss as 25, you will naturally gravitate towards an asset class which can give you a probably a better return, even if it is not risk adjusted.
Welcome to this episode of MF Bharat, Learn from the Masters. Today, we have Mr. Rahul Pal, who is the Chief Investment Officer, Fixed Income, Mahindra Manulife Mutual Fund, to demystify debt markets and debt mutual funds. Rahul is a chartered accountant and an alumni of St. Xavier's College. Prior to joining Mahindra Manulife, he was associated with Taurus Asset Management Company as CIO Fixed Income. He has also worked with Sundaram Asset Management Company as Fund Manager Fixed Income. In these roles, he was responsible for managing and overseeing the fixed income portfolios. Now he manages several active debt and hybrid mutual fund allocations for Mahindra Manulife. Welcome, Rahul, for this episode, and thanks for taking your time out. The first question I would like to ask you is the debt funds were about 50% of the AUM for the mutual fund industry about 8 to 10 years back. They seem to have shrunk to 23% as of now. Although AUM in absolute terms has grown decently well, why do you think investors are preferring other investment avenues as compared to the debt mutual funds?
Good morning. Thank you for having me here. I start with a very uncomfortable question, actually. And the reasons are obvious. It's choice between asset class that can endure returns over a long period of time and excite people and be more tax efficient. Combine the three of them, you produce a magic which is called equity mutual funds. And when the median age of India is still 28 and below, and we're talking about maybe at 22, when we'll discuss as 25, you will naturally gravitate towards an asset class which can give you probably a better return, even if it is not risk adjusted. So a combination of demographics, tax, long-term thinking, people becoming much more aware, that creates the magic where people prefer to have more equity than fixed income. But
Plus, I think it offers instant gratification.
That's come recently,
Huh.
but that was not the starting point for gratification.
Right.
Now the fact remains that longevity is much more preferred in terms of your investment horizon. But also remember one thing, demographics. This median age will also transit.
Right.
That will be the cliff where debt funds come into the fore. Asset patterns or investment patterns are not a secular behavior.
Right.
A very important part of it is demographics.
So when the median moves to about 30, 32, I think that's the time you're saying.
I would assume that the median age has to, I don't have a number, a handle on how long would it take the median age to move to about 40. But let me put it this way, maybe in the next 20 years.
Right.
So it's a 12 and then you average out to 40. That's when traditional fiscal cliffs happen. That is, you start thinking about how to provide certainty to your income, and that's where the role of fixed income debt funds come into play.
Right, right.
It's not an if, it's a when. Most geographies across the world have transitioned based on demographics.
Right.
Because we believe that the old order resembles one of the US or Western democracies, where people have gravitated a bit towards that, a pension which is much more fixed income. But maybe India is a very changing. We'll only come to know the story at the end of 20 years. But the starting point is the demographics look favorable at this moment, but then they turn unfavorable, and that's where the debt funds come into arc lights.
So, I mean, what do you think is the single most misunderstood aspect of fixed income investing in the current market regime?
Higher the return, higher the risk, higher the return.
Right.
No, which I think is a myth across financial markets. You always lower your risk to maximize your return. That's what value investing is all about. That's what margin of safety is come about.
Absolutely.
But in fixed income, a higher coupon attracts. Higher the risk, higher the return. But maybe not. I think credit risk is the most or misunderstood. And if you look at a credit defaults which linger on with the retail investors, the starting point is a high coupon.
Right.
I won't name names, but that's been the starting point. And that's a cardinal folly of the retail investor, which says a bit higher returns, maybe I'm adjusting for the risk. Maybe not. I think that's the
Absolutely.
single most important folly of an individual investor.
So instead of taking that sort of a risk in debt, it's better they take that sort of a risk in equity.
Absolutely.
Yeah.
And absolutely. And you can take, but hopefully now we are shifting to alternative investments, private credit funds, which would probably do a better job in managing that kind of risk. That's what,
Absolutely.
and that is where the next phase of growth can happen in fixed income also, which is beyond the traditional mutual funds, but the private credit markets in India is also growing tremendously, just like what's happening in the globally.
Yeah, yeah.
It's not democratized yet in terms of retail participation, but maybe someday it will.
Now, in case of equities, when an investor prefers to invest into equities directly, it's quite easy, simple. What do you think are the roadblocks due to which investing directly into the debt market or debt paper is still not common for an individual investor? And what further reforms are still needed to deepen the India's bond market?
So let me start with the second question first. I've been in this market for the last 25 years, and there's a perennial question: how do you deepen the bond markets?
Right.
People only look at the asset size of development. I mean, do you need more municipal bonds? Do we need more trade derivatives and all of this stuff? The liability profile is equally important. What kind of liability profile do you manage? If the liability comes in terms of pension funds and insurance, those are long term. Those are long term money, which means that you will have to have a buy and hold, which is a primary market develops, not a secondary market. The liability profile, and that's across the global. That's also followed from Korea, US, to wherever the developed bond markets are there. It's a function of your liability profile. Remember the age demographics as I talked about.
Right, right.
If you need a secondary market development, that means the liability profile is volatile. You have ins and outs, which can happen through mutual fund. But mutual funds need to then have a tax incentive built on liabilities. That is, considering tax, there is no incentive as such. But remember, there was a time period where mutual funds had a taxation which was a bit favorable in terms of
Absolutely.
short term and long term.
Yeah.
And if you look at transactions, then the secondary market liquidity was much higher vis-a-vis the primary market. As secondary market vis-a-vis the primary market, when you do a ratio of it, which means tax or tax outflow and inflow, that how do you manage tax, was creating a volatility of flows. The volatility of flows create a volatility of the asset class that you manage.
Right.
That creates secondary market liquidity.
Yeah.
So those are two different liability profiles. The corporate bond market can continue growing as long as the national pension scheme, the provident funds, insurance companies grow. But that's a buy and hold investor. If you want a secondary market liquidity, besides credit derivatives, etc., which are much more exotic, if you can create a tax incentive, that creates a secondary market liquidity. The liability profile is important, not the asset profile. And then if you can load that up with a bit of what I call leveraging, that makes exciting. You want real secondary market liquidity. I know I don't think so. That's very encouraging. The idea that leverage creates incentives. It can create incentives downwards, but not in the mutual fund space, but in the alternative space, you can create a secondary market which leverage happens.
Right.
That creates, limit the leverage, limit the asset class, that creates the incentive for corporate bond markets. So you'll have to think in that fashion. Now, otherwise, I think let's remember one thing: the starting point, a very great GSEC market. It exists in India. Settlement systems in India are
Superb.
unparalleled
Yeah.
in terms of the market infrastructure. In India, you can just hit a GSEC, it comes to your account. Nobody in the globe has it. The corporate bond market, it's also there. The starting point is great. I have to have age in my favor. I have to have liabilities in my favor. Corporate bond market will evolve automatically. That's what my personal thought.
You've seen multiple interest rate cycles. I mean, first of all, where do you think our interest rate cycle right now is? And more important, what's your biggest learning as a fund manager in the last so many cycles?
Let me put it this way. let me dwell a bit philosophically on this. There's a Latin phrase called amor fati, which means, which was Nietzsche, the German philosopher who talked about it, which is embracing life as it is. When you're in the financial markets, you embrace cycle. It's a very positive embracement,
Right.
which means you embrace cycles, you embrace volatility, and you embrace uncertainty. I have heard so many people talking about cycles, volatility, and uncertainty, that this is the most volatile time, this is the most uncertain time. Remember, every year is equally volatile,
And
equally
uncertainty,
uncertain.
yes.
Then why do we lament upon the words uncertainty and volatility? If you have been in the financial markets 25 years, amor fati, embrace it. That's one. No. B is that cycles exist. People just forget that. B is that every asset class offers a very finite pool of returns. You again tend to forget that. And what I've also observed is in the extremes of cycles, where the return cycles are an extreme, either way, the worst investor behavior comes in.
Yeah.
No. Which means that I can be very philosophically be very prudent, but there's also something called in behavioral finance something called the empathy gap, which means that you are of your worst behavior under emotional strain. No. This is pure behavioral. This is what genetics is.
Yeah.
So the only way you do is to assume that you will do certain tasks.
You
when
need to
faced with the
apply. You
cycles.
need to apply what you-
Practice.
yeah.
Practice is extremely important of overcoming a behavioral trait.
Right.
Remember, and I deviate a bit more into SIPs, or dollar cost averaging as we call it, is the best form of overcoming the empathy gap, that even if the markets go down, you keep on investing.
Right, right.
How do you bridge the gap? So that's one part of it. In terms of your asking about where in the interest rate cycle we are, remember, most of the rates are up 100 to 150 basis points, where the RBI has not done anything.
Right.
In fact, counterintuitive is the fact that if we look at the last 1 year, RBI has actually cut rates, like 6.5 to 5.5. But the rates have moved exactly in the opposite direction in terms of not following what the RBI is, which means the market developed a mind of its own and decided to say, look at other variables. We believe that, and if we start measuring interest rate cycles, we believe that we have covered the journey 75 to 80% of it. We probably go 20% further away.
Okay.
So there is no, I hesitate predicting whether peaks and troughs, like that's not my game. But what I do know is that you're at 75%, and it is based on the idea that returns generated to the investor, let's suppose if you had done an SIP on a gilt fund or a gilt index, it is close to, at this moment, 5%. 5%, the median is 7.
Right.
The low is close to 4 to 4.5. So
Okay,
that's what
okay.
we are predicating, the idea that that 5 will eventually go to 4. That is the time when people will say that why should not interest rates move further up? Investors will actually withdraw money instead of putting in money, and the noises will be about how the fact that interest rates can go up further. But remember, what people fail to ask, is it in the price? And that's the most important question that needs to be asked. Whatever you hear the noise about oil prices or a commodity,
whether it's there in
is
the
it in the
price.
price or not? The only way you judge is figuring out where you're in the return cycle. We believe that a part of it has to be still left, not much, but a part of it is still left. Then the reversal of the interest rates cycle starts. And you do not know the reasons why they will reverse.
Yeah.
They come with the benefit of hindsight, not with the idea that I know it and it hence happened.
So basically, how long do you think?
As I say, the fact that I do not predict
Right.
about the turns. What we say is simply this, and it's a bit of a different way of thinking if I have to add it. Whenever the, let's suppose the return cycle drops to 4%
Yeah.
or less than that, it is the time to invest. Start investing. That is the interest rate reversal will happen.
Okay.
That means all the noise is there in the price. And also remember, why we fail in predicting when it will end is simply because most of the movements happen in the shortest period of time, which is the Pareto's principle.
Right.
The 80% movements happen in the 20% of times. And hence the difficult to predict time. And hence I look at the return cycle to say the fact that if the return cycle has dropped to these levels, the probability of interest rate reversal starts. Reasons I probably would not know at that point of time.
And those triggers at that point of time also we're not too sure of. What can trigger that? The last closing sort of a move.
No one
Yeah, no
knows
one can.
about
Yeah,
it. No
exactly.
one knows. In fact, at that extreme ends, the people assume secularity. No,
Yes.
I remember the end of in 2016 demonetization, and people were talking about the stories about how in the fiscal deficit of the government will reduce dramatically, the currencies will not come into play, and then suddenly people thought that interest rates will drop, and they did exactly the opposite because the long-term story then was commodities rallying. No, remember? So
Yeah, yeah.
that started moving, and then you started following it up. So at the point of extremes, noises deepen. Noises become shrieks, and behaviorally you're in tune to, as even if you're a money manager, you listen to the noises rather
Right.
than the cycles.
Right.
That's again as I get the emotional or the empathy gap. I have to bridge that. No, and it's a difficult, easier said than done. But what I feel, if that's the end of the cycle, the probabilities, markets don't work on certainties, they work on probabilities.
Yes.
So then we think the fact that we tell people that we believe that the interest rate cycles have peaked out, people have to shift the duration, RBI is probably behind the curve, and maybe not. But that's where you start thinking a bit more deeply about the markets.
Sure. How much do you think the global factors like the US Fed decisions impact the Indian debt markets today?
Largely, it's a cross spectrum. It's not. If I only wish it was limited to Indian debt markets, but as you know, it crosses all
It's
boundaries,
across, yeah.
across
Yeah.
geographies, across asset classes. Directionally, they matter. That is, rarely has been their case, if not any, where US rates have moved up and down.
And
Indian, we haven't.
Okay.
We have behaved very differently. The intensity has changed over the years. No, so the intensity has changed, which means, and hence, because of the change intensity, today India versus US rates are compressed. It's because of the change intensity, not because of the direction. So that's one, and you can't overlook that. And but I would still like to believe that this is the closest, nearest intensity that you probably have. I mean, a US 10-year at 4.5, India 10-year at 7%, a 250 basis is probably the lowest you can get. I hope I don't have to eat an humble pie on it, but that's my best guess.
And that should shrink further going ahead?
I would hesitate to say a yes to this because, as I said, the fact that if you look at the probability spectrum, you're at an extreme probability. These things happen. These are outlier events.
Okay.
And when outlier events happen, I wouldn't want to bet on the outlier events. I mean, if you look at the probability distribution factor, it's a 10% occurrence of this event. I don't want to put my money on a 10% event.
Yeah,
I would rather put my money on a 90% event. With the belief that the entire or these spreads follow a classical normal distribution pattern. I mean, remember, I'm also talking statistically. So it's a normal distribution. We hope it's a 3 sigma event. It's not the normal. So I'm not anchored. We get anchored to a particular spread. But at this moment, I would like to bet on probability stress of the fact that this spread should not likely hold for long.
Okay. And how different or similar was COVID vis-a-vis 2007-8 financial crisis from the point of view of the Indian debt market?
One was it was closer home. Let's remember it. You felt it.
Yeah.
2007-8 was a bit far. It was a geography which was distant. You may have a financial implication, but not a real life experience. That's
Exactly.
very fundamentally different.
Yeah.
B is that I wasn't much bothered about the COVID-like situation, barring the health issues, simply because the playbook of 2007-8 was ultimately the governments intervened in some fashion. The central bankers intervened in some fashion. The playbook has been established. The playbooks were replicated in this fashion. Government, RBI, interest rates as a public good. These are very new terms. Remember, interest rate as a public good. But my whole point is the playbook has now unfortunately been quite established. When you hit the dirty ground or you have a problem, you have to look up to the central banker, you have to look at this, and which is rightly so. In so much as you may not want it, you'll have to depend on it because they are our last resort.
Absolutely.
So the government, the playbook was almost replicated of 2007-8. Thankfully, the crisis was, a part of it was credit crisis, but the credit crisis in India came a bit before that, 2018. So we didn't have to weather a credit challenge in 2020. The credit challenge was already there of 2018. 2020 was more of a liquidity challenge, a challenge about sentiments, and that's where the central bankers stepped in. And
Right.
globally, it was a synchronized global move. And remember, again, what has happened is global central bankers seem to work more often than not today in a synchronous fashion, barring some frontier geographies. That's what my take is. So similar, because the playbooks were exactly the similar.
Okay. And as far as investors are concerned, how should they decide between short-term and long-duration debt funds?
Since both are tax agnostic,
Yes.
volatility.
Mm-hmm.
Classically, a long-term debt fund will be much more volatile than a short-term
one,
fund,
yeah.
which means that there is a possibility at some point of time, the risk-adjusted returns, when you adjust for the volatility, a short-term fund may be better off than a long-term fund. But that's not a gospel truth. Let me put it this way. So difficult for the investors to judge, but I would like to believe that if you prefer a lower volatility, but a risk unit, the return per unit of volatility a bit higher, a short-term fund is a good enough space for investors in the fixed income space.
Okay. And in debt investing, I mean, what are the risks which are underestimated by most of the retail investors? I mean, and typically, what are the mistakes they make and how to avoid them?
Generally, I do not question the wisdom of the investors. We assume that they act in a very rational behavior. That's the starting point,
Right.
which is not true more often than not. So my thinking is, as I said, the first assumption is a higher coupon is a great idea starting point. Maybe
May not be.
maybe not. That's the question, and I think that's the single biggest challenge. And I would just leave it there, because that I have observed has been the one secular challenge that you have been facing. And hence you end up comparing against a debt fund, which probably gives much lower return. And if your return, let's suppose you start with, I'm just giving a number, 12%, and you make return out of it, you think you have made a deal about it. No. But it's almost like betting about the consistency of that approach. The ability of Sachin Tendulkar to hit a 4 versus the ability of repeat by a Harbhajan Singh. I'm just giving names, just for the, not for the sake, but the repeatability of it. So will all of your investments which give you 12% return have that same probability of delivering at the end of it? That's a judgment that I would leave it.
Right.
So which basically means that if you have been, if the returns are good enough, or let's remember you have taken a risk behind you. You have not lowered your risk. You're taking the risk volatility of the credit risk has been far higher than the coupon. Mispricing of risk could have happened. That I do not want to. I think that's the single biggest graveyard a retail investor would probably have faced when investing in bonds.
Now, for a person who's only been investing in fixed deposits and never invested anywhere else and keeps renewing his FD irrespective, looking at the best sort of interest rate which his particular bank gives, I mean, what would your message be for a person like that who is now planning to invest in a debt mutual fund? Because see, I mean, they've been doing it basically out of fear or ignorance that something like a mutual fund exists, or possibly inertia.
Yes.
Something is going on, let it go on. So, what would your message be to them? And how would you help them choose the right sort of a mutual fund as compared to FD?
As you correctly said, behavioral inertia is a great starting point, for assuming your investments. It helps also. An SIP is actually a behavioral inertia. I keep on referring back to an SIP because it's my favorite tool. It's a behavioral inertia. So let me put it this way. Which FD allows you to invest for one day at a return which probably is better than a fixed deposit or a current account? A current account does not miss you. There's an overnight fund for it. Remember, we're talking about tax agnostic. B is which deposit allows you to break. You can choose the amount that you want to take back into account
without a penalty.
Without a penalty.
Yeah.
I don't think so that that's available there. 3 is the ease of doing transactions. I would like to believe that we have gravitated a bit more easier in here than in a classical bank. Things are changing very rapidly, but that's my submission. And I also want to leave you with a fact that unknown to people, individual investors, retail plus HNIs, do invest in fixed income. The number is close to 3,75,000 crores. That's an AMFI number.
Okay.
That's a large, people think that they don't, but they actually do. That the numbers are close to 3,75,000 crores. And what surprised me when I was looking at some data, the folio increase in retail in liquid fund in the last 1 year, it's an AMFI data, is 55% increase in folios. That is from 15 lakh to a 22 lakh folios. That's something to ponder about.
That's a huge change, yeah.
Yes. Is there a shift happening? And remember, is there a shift happening gradually? It's becoming unnoticed. It will only get noticed when it becomes a noise.
Right.
Is there a shift happening? And B, is technology facilitating that? Something that I would give. So the idea that individuals do not invest, they do. Is there a gradual shift happening in behavior because of technology? I think the answer is yes also. So I am a happy man.
Yeah, that's a huge figure. 15 to 22 lakhs is a
Yes, that's
huge,
that's an AMFI number for you to look at it.
Okay. Now, dynamic bonds, have been the flavor for a while, but now we have seen that they have underperformed over the last 2 years. It seems that the fund managers aggressively increased portfolio duration in anticipation of a sharp fall in yields, and that never really happened. So, if you can just elaborate on this.
So, a dynamic bond fund is an akin to flexible, a flexi
cap fund.
So, let me put it this way, the equivalence. I would not comment for other funds, but we kind of brought our duration down dramatically in February simply because we thought we were peaking out an interest rate cycle. Whether RBI cuts or not cuts was not for us. As I said, our fundamental concept is our fundamental concept is remains on the interest rate cycles as a fund house. B is we, as I said, we kind of always extend secularity. Remember, at that point of time when interest rates fall, you also have monies coming in because of the past return. The monies have come to you with the idea that they need to be deployed.
Right.
What do you do then? Now, it's again, if at that point of time you'd actually investors redeeming, you'd have seen a gradual decrease in duration. So you're also a function of your liabilities, which probably behave exactly opposite to what you would have thought. And hence, how do you take an independent decision without the flows? We have tried, as I said, that I have worked on some behavior for myself, which I know there are several challenges, and hence this emotional gap. How do you fight the liability versus what you are thinking? The liability may be wrong. It may be an irrational behavior. Yet, how do you challenge that? How do you convince yourself, no, I don't, I think they're getting it wrong. So that's one part of it. But yes, a part of the challenge can be liability, part of the challenge can be noise, because you are on the treadmill every day.
Right.
You get questioned, your NAVs are published every day, your rankings are there, and if you falter, it's, as I said, that it is better to fail conventionally than succeed. And this is this famous quote, right? It's better to fail conventionally. I think sometimes we kind of behaviorally we want to fail conventionally rather than succeed unconventionally. So I rest my case there, and I speak on behalf of all dynamic funds.
So I think what generally has been done by some of the small cap mutual funds, where they have stopped taking fresh money. That could have been done as far as the dynamic bond fund was concerned.
It's such a small category. It's such. If you look, if I'm not wrong, it's like a 20,000 crore category.
Right.
It actually does not move the needle in terms of interest rates. No, it does not move the needle. And hence you cannot stop. I mean, it just does not work that way.
Okay.
So that's my, again, I speak on behalf of dynamic bond funds, that you can't, it's just a small category. And it's our only play where you can bet on interest rates.
Right.
Across. It's what questions your intellectual ability. Please don't deny us that sometimes.
Finally, I think AI is the buzzword as of now. Equity fund managers have started using AI to support their decision making, not decision making as such. What about fixed income? Will AI play an important role?
Okay. At Mahindra Manulife, we have been doing a bit of AI, but it's in a very different aspect. Uh, I keep on repeating the fact that I look very carefully at the annual reports with the idea that I hope the financial statements are true and correct, not true and fair, which is usually the
Yes,
case. I'm
yes.
myself a chartered accountant. Between fair and good is a long distance. True and correct is a long distance. We kind of were doing an experiment around the fact that if I were to ask an AI to look at red flags, I found some very interesting results, accounting red flags, which I had missed.
Right.
CSR provisions versus no CSR expenditure. I couldn't think through. The AI helped me thinking that.
Right.
So this B is that how do you test your decision making? How to remove, as I said, the behavioral gap. What was the rate saying? What were your decisions? That's agnostic to markets. AI would help me doing that. And of course, the common things, credit research reports, look at certain other, how do you agglomerate various rating agencies reports, all of that stuff, which borders on how to make it more efficient, has already been done. I think people are mostly talking about efficiency behind AI.
Absolutely.
I would be looking at more about the intelligence behind AI. How do you make a better decision using an AI?
Right.
So, which means credit as well as evaluating own behavior. I think for us, that remains the cornerstone. Efficiency is important. I'm not denying that. No, but the intelligence word is also equally important. I would focus on that piece also equally.
Okay. And now coming to some rapid fire questions, you can keep the answers short. I mean, which debt category looks most attractive today? Liquid, short duration, corporate bond, gilt, or dynamic bond funds?
Corporate bond.
Okay. And how significant is India's inclusion in global bond indices?
Good to attract capital, but let's remember flows do not naturally create direction of interest rates. Because if there are flows, for every buyer, there's a seller.
Right.
Right. To assume that the buyer is correct is a fatal mistake. Remember, in law, they say caveat emptor.
Yeah, yeah.
It stands still. Flows is good to attract global capital, but do not equate flows with direction.
Okay.
Remember, one of the biggest flows in corporate bond has happened because of the JP Morgan Indian inclusion. Yet rates have increased, currencies have weakened. That went against the starting principle, right? Flows should have led to a capital, rates going down, finally currency getting better.
Yeah, yeah.
But they did not, because and that's the beauty of the markets. The starting point, rational thinking, sometimes turns out to be exactly the opposite. So good to have. Let's attract, because India, we need to have.
We need the funds.
We
yeah.
need the funds.
Yeah.
So we make it a bit more better in terms of taxation, in terms of withholding taxes, attract capital, which also means the fact that your fiscal deficits have to be a bit curtailed, because this FPIs look at your numbers very carefully. And it's great to have foreign flows and ensure that you have everything else in fact, the market infrastructure. Even if they were to go out, how do you manage those kind of risks equally? I mean, to assume that they will always be here is also a fatal mistake.
Okay.
That's what I mean. At the end of the day, the flow seeks returns also. They develop, and if at the peak of the cycle they think the fact that I think we have generated enough returns for ourselves and there are opportunities outside,
Right.
they will exactly behave what happened in equity inflows. Right? So
They'll move out, yeah.
those instincts will always be there. I don't fight that. It's a very welcome thing. More flows, better for the Indian market, the market infrastructure, liquidity, the number of people who invest in India bonds. So it's great to have them.
Okay. And about the Gen Z, I mean, young investors are quite equity focused. So why should a Gen Z care about fixed income? I think you answered this earlier also, but if you just
They are
repeat that.
doing it without the noise being created. In
Right.
some aspects, they're doing it. Not with traditional fixed income, but yes, they are there.
Now tell me, 15 lakhs to 23 lakhs, number of folios increased. Decent number is Gen Z. Any idea on that?
No, I don't have an age profile.
Okay.
But I would like to believe that it's the Gen Z. It is the Gen Z. I would like to believe that.
I mean, where do you see debt mutual funds in India over the next decade? Even this one you answered to a certain extent earlier, but
The age cliff, if it helps us,
right.
I'll be in a different zone.
What is one misconception about the bond markets you want to break today?
Falling interest rate is good for equity markets. Rising interest rate is bad for equity markets. I think that's a fundamental concept. I've been talking a lot about it. Low interest rate is good for equity markets. High interest rate is bad for equity markets. The flow versus stock concept. A rising interest rate generally is good for equity markets.
Okay.
A high interest rate is not. A falling interest rate. Show me one geography in the globe where there has been a falling secular interest rates and equity markets have boomed. Otherwise, Japan would have been the world's best performing equity markets. They are not.
Yeah.
Low interest rates are good because they create the risk appetite. So that's one perception on the bond equity linkage I want to talk about.
Sure. So that's it, Rahul.
Sure.
Thanks for your time and such an insightful conversation.
Thank you for having me here, and thank you for all your indulgence.
Thank you.
Thank you.
Thank you, viewers, for watching this episode, and do subscribe to MF Bharat for such interesting conversations going ahead.